All right. Joining us now on Market Guru today, Shiv Puri, Managing Director, TVF Capital Advisors. Shiv, good to have you with us. Let me get a sense of what you're really watching out for in terms of global cues and triggers at this point, Shiv. We've had so much uncertainty the last couple of weeks. What's top of mind for you?
Well, I think globally the big theme from last year carries on, which is the bursting of the commodity bubble and the repercussions of that. Clearly China slowed down materially on their consumption of raw materials, and a lot of companies and countries globally were dependent on this. So we're seeing the ramifications of that. You've seen commodity companies globally lose about $1 trillion of equity market cap. That's not small. And it's almost certain that many of the companies in these sectors will see financial distress. So you're seeing the yields on their debt go up quite materially. So I think the theme from last year really carries forward to this year. I would say, though, that while this is a sort of near-term negative, probably headwind for markets globally, as far as India is concerned, this has to be positive in the long run, because the lower commodity prices is hugely beneficial to our country, and you're going to see that, I think, play out in 2016.
Okay, so when we're talking about India in the global context, everyone has been talking about how we're perhaps relatively better placed, but do you see any risk to being part of the larger emerging market basket, or do you actually see investors seeing India as a separate region perhaps going forward this year?
I think that distinction started happening about 2 years ago, where investors started looking at India separately. And you can see that in the performance of the Indian equity market in dollar terms versus some of the other emerging markets, especially against the earlier BRIC sort of acronyms that India was a part of. So I think that distinction is happening. That distinction is probably going to get even more stark as the years go by. People will realize once the turbulence is over who actually benefits from this. And if you look at India, I mean, the entire fiscal situation of the country, the government finances have changed completely over the last 1 year. The government hasn't really cut retail petrol prices by much, and therefore increased indirect tax collections dramatically, which has helped their fiscal situation. So you're going to see, I think that trend has already started, and it's going to pick up dramatically in 2016 and beyond.
Right. So, of course, we're watching out for the budget, Shiv. Are you then anticipating any major takeaways from the budget this year?
I think the budget, again, I hope expectations don't get too high as they have in the past few years. A lot of the activity in India, at least on the reform side, usually happens outside of the budget. The budget tends to become fairly political. And so, I think a lot of, I hope the expectations don't get up to too dramatically on that. Frankly, I think the budget doesn't have too much that, one can anticipate for. The key sort of decisions were carrying on from last year. Some of them have been implemented, and some of them are just stuck in political gridlock. So,
in terms of really the turnaround in the capex cycle, in sort of more orders for that spending to actually see an impact with regards to an actual recovery, when do you see that happening?
So I think that there's probably at least 3 to 4 quarters for that to happen. And the reason I say that is that the key driver for spending will be the private sector. I think the public sector spending has started to trickle in, especially in roads, and we're seeing some sort of easing happening in the power sector as well. But the real driver has to come from the private sector, and the reason the private sector is constrained is because of their balance sheets. So the real driver will come when credit to those companies eases, and that's only going to happen when the state-run banks, the PSU banks, are in a position to lend. And today, they're in the middle of a pretty violent NPA cycle and being, of course, forced to recognize the pain, rightly so. So I think over the next 6 to 9 months, the books of the state-run banks will really show what's credible. Once their books are cleaned up is when they will have the ability to sort of start the lending cycle again, and I think that's critical for the private sector spending to pick up.
So we've all been waiting for that to start happening. Shiv, you're sounding fairly positive overall on the outlook and that you do anticipate that this will happen. In light of that then, what are some of the pockets of the market that you're actually seeing being drivers going forward?
So I think the pockets of the market that will continue to do well is going to be private sector banks. As you saw last year, the top 3 or 4 banks, grew their earnings north of 20 or 23%, whereas overall credit growth was less than 10, and the banking system in aggregate had low single-digit growth. So that pocket of the economy will continue to do well. I think the rural housing finance companies will continue to do well in 2016 and beyond. Some of the big players out there again grew earnings in the north of 20% range. We see that trend continuing. We see that areas such as pharma, which has had, I'd say, cyclical issues related to the FDA and sort of their plants in India. I think that gets behind them in the next year or so, and that sort of secular growth rate continues to happen. The other interesting area would be in manufacturing. And I think there, especially if you look at certain areas in the capital goods space, those that we call consumables, which means that you regularly need them, even if you're not doing greenfield expansions, companies that make abrasives, for example, or ball bearings or things like that. Which are good businesses, and there you should see any pickup in demand that will happen perhaps in the second half of the year to result in significant operating leverage. So earnings will grow significantly faster than the top line because their raw material costs are down, and these businesses inherently carry a lot of operating leverage. So I think these 4 or 5 areas of the economy will do well in 2016.
Okay, so clear strategy emerging there. I want to also get your view on the commodity front because we've also had further reports coming in this morning from the World Bank. Foreseeing perhaps a little bit more pressure on the commodity side, whether it be oil or metals. Even though of course we have seen some amount of reasonable interest in metal stocks on declines, but it's something that seems to be rattling markets to quite an extent. How much more of a risk do you see on the downside with regards to commodities?
Well, that's always a hard thing to predict, but I think what is important is that the realization that the bursting of this bubble has ramifications. It's not pain-free for any asset class, including Indian equities. Or emerging markets equities, Asian equities. But I think the repercussions that we're seeing right now, if they get a whole lot worse, the risk is really that there happens to be some sort of a global accident, which usually will start on the credit side. So you hope that something like that can be avoided. But if there is, at some point this year, a stabilization in sort of commodity prices where that risk is taken off the table, then I think, countries like India are very well positioned to capitalize, going forward. I think, there's certain parts of the world, Europe, Japan, India, which are uniquely positioned to capitalize on this low commodity regime.
Fair enough. Earnings, of course, so far have been a little mixed. Shiv, in terms of earnings growth as well, when do you really see, the trend shifting? We are hearing things like second half of the year. Do you see it happening earlier? You're talking about a focus on private spending as well, and growth on the back of what we've seen from the government. Do you expect some of that to actually start seeing results perhaps by the next quarter? Is that still too early?
Yeah, I think a couple of points here. First is that for the real pickup in the economy to happen, investment has to pick up. Consumption cannot drive it alone this time. And as we discussed, for investment to pick up, private sector investment has to pick up. So, that is still, a few quarters away. Having said that, they are in, the growth environment that we're in right now. There are very interesting pockets of growth that we talked about earlier that I think will continue to grow. And so while the index as a whole, the earnings there may not grow materially, individual pockets will, I think, outperform quite dramatically this year, as they have last year. And I think that's what creates opportunity.
A lot of attention that's also shifted to central banks once again, whether it be the Fed. Again, we're watching out for commentary. We've got a policy meet next week. Continued focus on China. Anything that you're watching out for in particular with regards to commentary that might come in from some of these central bankers?
I think the central bankers just have to do one job, and that is to try and keep the credibility going. So whatever message that they've started on, for example, the Fed, the U.S. in terms of raising rates, I think it's important that they keep their standing and their credibility, because one of the key risks is, from a global standpoint, is if the investors feel that they no longer have that kind of credibility. My sense is that they're going to keep the message fairly consistent. As far as as India is concerned, we're not expecting any sort of cuts in interest rates. Last year the governor cut rates by about 125 basis points. Perhaps 65 basis points of that's been passed on by the banks. So there's probably some more room out there to go through this year. But I think largely, as long as they can keep their credibility going, that'll be a job reasonably well done.
Any other themes that you're eyeing when it comes to the Indian markets? We've been looking at some that have played out over the last year, NBFCs, aviation, logistics, some that perhaps may continue this year too. Any of these that you've also been looking at or watching closely to see if they perhaps will meet expectations going forward?
Yeah, I think the area is manufacturing, and again within that capital goods, because once these companies see the top line growth, which will happen, I think the operating leverage is going to be very significant. And I think over the next few years, if you're invested in sectors that benefit from lower raw material prices, those companies are, I think, going to continue to do well. Today, of course, we're in an environment where, the real GDP growth numbers are, haven't fully picked up, but the nominal GDP growth numbers are perhaps even lower because we've got sort of wholesale deflation, if you will. So, the top line numbers have to be looked into in that context. But still, I think that, anything that, and therefore you see vast sectors of the Indian economy that over the next couple of years will benefit from raw material prices, and I think that's the way to be positioned.
All right, Shiv, we'll leave it there. Thanks so much for joining us this morning in Market Guru. Always a pleasure.